Welcome to our special video as we delve into two monumental collapses in the world of finance: Bernie Madoff's stock market Ponzi scam and Sam Bankman-Fried's bankruptcy of FTX in November 2022. In the bustling labyrinth of finance, few names have been as prominent and polarizing as Bernie Madoff and Sam Bankman-Fried. Madoff, once a titan of Wall Street, crafted an empire on the pillars of deceit and illusion, orchestrating one of the most infamous Ponzi schemes in history. On the other hand, Sam Bankman-Fried, a prodigy in the realm of digital currency, soared to lofty heights with FTX, a multi-billion-dollar crypto exchange, only to experience a dramatic freefall. Madoff was a revered figure in the stock market, acclaimed for his uncanny knack for generating consistent returns. His investment firm, Bernard L. Madoff Investment Securities LLC, attracted a massive clientele, ranging from individual investors to large institutions. Little did they know, they were entrusting their wealth to a house of cards, precariously built on a foundation of lies. Parallelly, in the volatile landscape of cryptocurrency, Sam Bankman-Fried was making waves. A Harvard graduate and former Wall Street ETF trader, he co-founded FTX, a cryptocurrency derivatives exchange. In a relatively short span, FTX gained a reputation as a major player in the crypto industry, amassing billions in daily trading volume. But the facade of success was about to crack. It's imperative to mention that the stories we're about to unravel should serve as a cautionary tale about the perils of both the stock market and the crypto universe. It underscores the importance of being well-informed and conducting your own research before making any financial decisions. And remember, while we strive to provide you with accurate and insightful content, we are not financial advisors. Both these financial moguls at the height of their careers seemed invincible. But as we'll see, even giants can fall. First, let's rewind to the time when Bernie Madoff was a respected figure on Wall Street. With a career spanning over half a century, Madoff was a man who held considerable clout in the financial world. He was a former chairman of NASDAQ, and his investment securities firm was one of the top market maker businesses on Wall Street. But beneath the veneer of success and respectability, Madoff was orchestrating the largest Ponzi scheme in history, a fraud that would ultimately cost his investors an estimated $65 billion. The scheme was shockingly simple. Madoff promised his clients consistent, unusually high returns, claiming he was able to achieve these through a strategy known as split-strike conversion. In reality, he was using the money from new investors to pay off the old ones, creating an illusion of genuine profits. For years, Madoff was able to maintain this facade of prosperity. His reputation and charisma helped him attract a steady stream of new clients, from wealthy individuals to charities, and even universities. This constant influx of fresh capital allowed him to keep the scheme afloat, paying off his older clients while keeping a substantial amount for himself. But like all Ponzi schemes, Madoff's was destined to collapse. The financial crisis of 2008 was the final nail in the coffin. As the market plummeted, many of Madoff's investors tried to withdraw their money. Suddenly, the scheme's fatal flaw was exposed: there simply wasn't enough money to pay everyone. In December 2008, Madoff confessed to his sons, who turned him into the authorities. The fallout was catastrophic. Thousands of investors, many of whom had trusted Madoff with their life savings, were left in financial ruin. Madoff himself was sentenced to 150 years in prison, a grim end to a career marked by deception and greed. Madoff's downfall was a stark reminder that not all that glitters is gold. His Ponzi scheme serves as a warning of the dangers that can lurk beneath the surface of seemingly successful investments. It's a chilling testament to the importance of due diligence and the perils of placing too much trust in a single individual or entity. Never forget, if something seems too good to be true, it probably is. Fast forward to the world of cryptocurrency, where Sam Bankman-Fried was making waves with FTX. In the digital era, where currency has taken a quantum leap into the virtual realm, Sam Bankman-Fried was carving out a space for himself as the founder of FTX, a multi-billion-dollar crypto exchange. However, this promising venture met an unfortunate end in November 2022, setting off shockwaves throughout the digital asset industry. The unraveling of FTX began with the scrutiny of its relationship with Bankman-Fried's trading house, Alameda. Questions were raised, and as the curtain was pulled back, a complex web of financial dealings came into view. The revelations led to a liquidity crisis, a situation where the company was unable to meet its short-term debts. In a desperate bid to stay afloat, FTX sought a bailout, turning to its rival, Binance. But salvation was not to be found there. Binance backed out of the rescue plan, leaving FTX to face the storm on its own. The next domino to fall was the bankruptcy filing by both FTX and Alameda. As the documents were laid bare, they painted a grim picture of mismanagement and potential fraud. The man at the helm, Bankman-Fried, resigned as CEO, but the damage was done. The collapse of FTX didn't just affect the company itself, it sent ripples through the crypto world, causing other firms to face liquidity problems. Customers, sensing the instability, sought to withdraw their funds. One such firm, BlockFi, which had significant exposure to FTX, suspended most operations, preparing for a potential bankruptcy filing itself. Investors who had once seen FTX as a promising venture faced heavy losses. Venture capital firm Sequoia and the Ontario Teachers' Pension Plan, who had invested in FTX, marked down their investments. The personal fortune of Bankman-Fried, once estimated at $26 billion, was wiped out. His companies came under investigation by federal prosecutors, and the trust in the crypto industry took a severe hit. The collapse of FTX stands as a stark reminder of the risks involved in the financial world. It has drawn comparisons to the dot-com bubble and the fall of Lehman Brothers, but the outcome for crypto remains uncertain due to its largely unregulated nature. Like Madoff, Bankman-Fried's empire crumbled, reinforcing the precarious nature of the financial world. It's a sobering tale of how even the most promising ventures can fall, serving as a cautionary tale for those looking to venture into the unpredictable world of finance. The downfall of these titans didn't happen in isolation, it sent shockwaves through their respective industries. The financial tremors that resulted from the collapse of Bernie Madoff's empire and FTX were far-reaching and profound. Both events caused catastrophic losses for investors, but beyond that, they also had a significant impact on other firms and the overall trust in both the traditional stock market and the burgeoning crypto industry. When Madoff's Ponzi scheme was exposed, not only did it wipe out the life savings of many individuals, it also affected numerous hedge funds and financial institutions that had invested heavily in his fund. These institutions faced significant losses, leading to a ripple effect throughout the financial world. The scandal also led to increased scrutiny of hedge funds and other investment vehicles, resulting in stricter regulations and the implementation of more robust checks and balances. Similarly, the collapse of FTX sent tremors through the crypto industry. Firms like BlockFi, which had significant exposure to FTX, found themselves in precarious positions as a result of the collapse. BlockFi had to suspend most of its operations and even prepare for a potential bankruptcy filing. Other crypto firms also faced liquidity problems, and some customers scrambled to withdraw their funds, fearing a similar fate. Moreover, the downfall of FTX and the ensuing chaos eroded trust in the crypto industry, just as Madoff's actions had done to the traditional financial sector years earlier. Investors grew cautious, and some even compared the situation to the dot-com bubble or the fall of Lehman Brothers. The crypto industry's largely unregulated nature added to the uncertainty, making the outcome even more unpredictable. The collapses of Madoff's empire and FTX didn't just affect those directly involved, they had a ripple effect that reached far beyond the immediate circle of investors and firms. They shook the foundations of trust and confidence that the financial world rests upon. Investors, both big and small, were reminded of the inherent risks involved in investing, whether in the traditional stock market or the volatile world of crypto. The repercussions of these collapses serve as a sobering reminder of the inherent risks of investing. While these financial disasters have been devastating, they also provide valuable lessons. They serve as stark reminders of the importance of financial literacy and the need for caution when investing. It's not simply about jumping on the latest trend or following the crowd. It's about understanding what you're investing in, knowing the risks, and being prepared to face the consequences. Financial education is not just about learning how to make money. It's about understanding how the financial world works, recognizing the signs of potential fraud or mismanagement, and knowing how to protect yourself. The collapse of FTX and the downfall of Bernie Madoff underscore the need for transparency in financial dealings, the importance of regulatory oversight, and the role of personal due diligence. These events also highlight the need for diversification in investment. Putting all your eggs in one basket, whether it's a single stock or a single cryptocurrency, can lead to significant losses when things go wrong. Diversification can help mitigate these risks and provide a degree of protection against the unpredictable nature of financial markets. Even with these precautions, it's important to remember that investing always involves risk. The potential for high returns comes with the potential for high losses. It's crucial to only invest what you can afford to lose, and to be prepared for the possibility that your investments may not pan out as you hope. In the light of these events, it's also worth considering the role of regulation in financial markets. The largely unregulated nature of the crypto industry, for instance, can make it a breeding ground for fraudulent activities and mismanagement. While regulation can be seen as a restriction, it can also provide a level of security and trust that is vital in any financial system. Remember, we are not financial advisors. It's essential to do your own research before making any investment decisions. Learn from the past, be cautious in the present, and invest in your future wisely. In the world of investing, knowledge truly is power. As we wrap up this special video, we hope you've gained some insights into these financial collapses. We delved into the downfall of giants, dissecting the notorious Bernie Madoff's Ponzi scheme, and the dramatic collapse of FTX in November 2022. Explored the ripple effects of these events, impacted investors, billions lost in the process. Remember, these stories serve as a stark reminder of the dangers lurking in both the stock market and cryptocurrency world. It's crucial to educate yourself, to understand the risks involved, and not to be swayed by the promise of quick riches. We are not financial advisors, and we encourage you to do your own research. It's your hard-earned money, and you should be the one making the decisions on how to invest it. Stay safe, stay educated. Thanks for watching. Be sure to like, comment, and subscribe. And hit the bell notifications so you'll get updates anytime we upload a new video.